What's all this business about gold bar levels?
The market makers have set up the algorithm that dictates price in such a way that it engineers liquidity and then it captures that liquidity later, usually after dealing with an imbalance. In this video, I'm going to show you that this generation and capture of liquidity happens according to cycles, and these cycles are time-based and they're fractal. So I'll show you this using the Dow Jones Industrial Average Index, and I'm going to show you on the higher time frames. So let's consider 2024. And I'm going to break down 2024 into the 4 quarters, Q1, Q2, Q3, Q4. So we start with as close to the 1st of January as we can, the 2nd, and we will extend it to the end of the year. There we go. So these are the financial quarters, Q1, Q2, Q3, and now we are entering Q4. So let's analyze the price action for Q3 to demonstrate exactly how the algorithm functions. It's a pretty simple algorithm, and its function is to take out liquidity, to generate and capture liquidity. So as I said, the algorithm, when it functions on cycles, is fractal. So our Q3 can also be broken down into 4 fractal quarters. There we go, Q1, Q2, Q3, and Q4. So let me relay price action slowly so we're all on the same page of what has happened. The first quarter of the third quarter of the year is designated by this price action here. And why don't we just draw out that data? Okay, so this is all the price action in the first quarter of the third quarter of the year. And we can call it Q1. So what did the algorithm do? It engineered liquidity. So we have buy side liquidity here and sell side liquidity here. And then we closed in a slight discount. So what is the purpose of the algorithm? The purpose of the algorithm, when we start a new quarter, is to attack liquidity. Okay, so your job as a trader is to understand, is it going for buy side liquidity or is it going for sell side liquidity? And once it captures one side of the liquidity, you have a very good idea of what your bias should be and where price is going. And trading is all about knowing which direction price is moving. Once price is moving in a certain direction, it's just a matter of placing your entry and your stop loss. That's it. So let's play this through slowly. Okay, so the magnets, okay, what are the draws on liquidity, as ICT calls them? Okay, so this is your sell side liquidity, and this is your buy side liquidity. So you can use this information to create your own trading strategy. I'm going to give away a lot today. Okay, so let's see what happened. Right. So what did it do? It looked like it was going for the buy side liquidity, and instead it is started to attack the sell side liquidity. Bang, sell side liquidity has been taken. Okay. At this point, now that this liquidity has been captured, what is the drawn liquidity? This is the remaining drawn liquidity. Okay, we've had our sweep on liquidity. So now the drawn liquidity is here. All you have to do is find a point at which you think the algorithm is going to reverse, and then you have your bias. So what do we have here? We have a gap. Okay, so this is the daily time frame, so we have a daily gap. Okay, and it was probably, there we go. So it's a new week opening gap. There's your new week opening gap. Okay, so price has filled the new week opening gap, and we now expect the drawn liquidity to be here because we engineered it before. And we also have our trendline liquidity. You see? We're now moving in the right direction. Okay, so we have captured the first part of the trendline liquidity. And we have, there we go. We have now swept this liquidity here. Do you see that? So now let's draw out the action for Q2. Okay, that was the price action for Q2. So what did Q2 do? It took the liquidity from the previous quarter. Once that was captured, we then attacked the remaining liquidity, which was the liquidity at the top of Q2 and the liquidity at the top of Q1. Now that we have captured the Q2 and Q1 liquidity, where is the remaining liquidity? So we are just about to finish Q3. So let's draw Q3. Okay, where is the remaining liquidity? And you should start keeping a check, almost like a bank balance, of how much buy side and sell side liquidity you think the algorithm has. Okay, so initially we attacked sell side. Okay, so we need some buy side to compensate the offset accumulation. Okay, so we initially attacked sell side. So we then went for buy side and then buy side. Now we have an excess of buy side. Okay, one sell side, two buy side. We have an excess of buy side. So what do we need to attack? Okay, we need to attack the sell side liquidity again. So as we enter Q4, the final quarter of the third quarter, we are expecting this to be the draw on liquidity. Quarter started, bang, we took it straight away. There we go. Now, what's our tally? We are now flat. What are we going to attack? Where is the remaining liquidity? So we had some down here, but that's some ways to go. Okay, it's much closer to now attack this liquidity. So let's see what happened at the end of the Q3, the third quarter of the year. There we go. We finish our offset accumulation. We broke through it quite convincingly. There is your Q4. Let's just play out the price action for Q4. Okay, now we are in the final quarter of the year with Q3 complete. Okay, I want you to start thinking about these concepts and really fractalize it down to the time frames that you trade on. And by understanding how the algorithm engineers liquidity just so that it can target it later, and it does a process of offset accumulation going into areas of inefficiencies, okay, and also mitigating order blocks to pick up those outstanding orders, you should have a much better idea on which direction price is going, what your draw on liquidity is, and what your bias should be. Okay. If you would like to learn more about how time and price functions, there's a link to my golden bullet trading strategy in the description to this video.
What's all this business about gold block levels?